Don't forget, his mission is colonize Mars, right? Occupy Mars.
Yeah.
And I support that vision. I think you have to dream. If you only try to hit something out of you hit something out of the ballpark, you're only really ever going to hit the bleachers, right? He's trying to hit Mars. He'll probably end up on the moon. I've met families who made billions on a specific component supplying oil and gas pipelines, like just the cuff.
That widget.
The widget.
Damn.
Billions. So suddenly it's not sexy anymore to be a portfolio manager or a relationship manager at a major institutional bank managing ultra high net worths. It's now cool to work as a portfolio manager / asset manager inside a family office because you get to see really cool deals. You get to deploy capital at scale. You have the trust of like the owner of the business of the office.
As you just heard in the sizzle, we're talking about the future of private equity. And we couldn't think of anybody better than CEO and co-founder of Helios Worldwide, Mr. Humphrey Ho. And Humphrey's got some cool stories to share. I think you're really going to enjoy this episode. But if you want to get to know him a little bit better, we have a companion video to this episode called Get to Know Humphrey Ho. And without further ado, let's dive into this. I've been reading a lot. I mean, you and I talked about it a little bit. Where do you see the future of private equity?
I think private equity is going in a place of democratization. So with 401ks now being able to access private equity, you're going to start seeing not only ultra high net worth, but high net worth, and also just retirees and average folks being able to participate in what traditionally we deem as private equity that was really limited to institutions and ultra high net worth. So imagine, I was just telling somebody earlier this morning, Angel Plus. So mom and pa used to drop maybe $5 or $10 or $25,000 at a company that had extreme risk. These were companies that were a PowerPoint and maybe their first prototype. They'll now have access to companies that are maybe $5 to $25 million in revenue, which usually is the dictation of success in the States. It's not a guarantee, but if you've made $5 to $25 million in revenue a year, you're pretty stable. And you can still pitch in that $25,000, $50,000 check and be part of their growth story. And I think that private equity is going to be going that way in terms of democratization. The second thing that I think private equity is going to go in right now is a need for what we call organic growth or organic revenue. So the last several years, cheap money has been so easily accessible that you could invest in anything, mostly space tech, AI, agentic AI. But now you're realizing, and a lot of larger private equity is realizing, okay, that's an 8-year hold. All right, so what gives us immediate returns, right? So we're going to start seeing private equity go into places like CPG, right? Fashion, luxury, beauty, wellness. It yields almost right away. There isn't a 7-8-year hold. If you don't want in that business, you want to send it to the next series, a Series B or Series C or Series D, you could do so within a relatively acceptable period of time, 2 to 5 years. So you're not holding on to something too long. So those are two major trends that we're watching right now.
So when you talk about those holds, let's say between 2 or 3 years to 8 years plus, what's so significant about that from your perspective? Because it's kind of your role to deliver a dividend, right? Or a return. So why is that more prevalent now than before?
Well, there's several reasons.
Okay.
Number one, money's not cheap anymore. So
Yeah.
I rub up against a lot of this exact conversation. Why would I invest in X if I could just invest in oil and gas in an oil pipeline? It would yield 6% tomorrow and I'd get it every quarter. True. Why would I invest in X if I could just invest in treasury bonds and I'd still get 5.5% sitting there doing nothing? True. Because interest rates are high, they will likely remain high for a very long time. You're starting to see scenarios where traditional investors, which have a lot of capital to allocate, are being more conservative. And so when they look at parts of their portfolio, they do have to be aggressive in some places. So they'll invest in AI, they'll invest in semiconductors, they'll invest in the next generation of software computing and data centers, et cetera. But now that wave is just coming to an end. And the good part about this is this. They're also looking at revenue generating businesses immediately, or we need to look at businesses that generate distributions or dividends relatively quickly because you have to have that happy medium. it goes without saying, investing in what's going to happen in the future is going to be a long hold. You're not going to see an electric car become as great as Tesla if you don't hold it for the 11 straight years. It is what it is. But at the same time, you don't have to be all in on that exact thing, right? There are people who are absolutely convicted in one particular industry or a particular investment thesis.
Yeah.
But like most other folks, people who especially are ultra high net worth, family office parts of private equity, they're used to receiving dividends and distributions. This is not the kind of institutional investor that has a relatively long time horizon with no payout. And so family offices, ultra high net worth individuals who may have managed their own money in the past by themselves with a trusted financial advisor, these are people that kind of expect, wait a minute, why hasn't that thing come to fruition after, wait, how long? It's going to be 7 years? Oh, God. And so many of them do have an invisible time pressure to receive dividends and distributions, either because that's how they fund parts of their living, or B, because they want to show results and move on to the next thing. And so having a diversification in things that yield, such as CPG, fashion, luxury, beauty, and wellness brands, it does help sort of hedge against the really long holds.
Yeah. You mentioned Tesla because of just your purview on things. What do you think that Elon Musk did what he did with the Model S, Model Y of discontinuing them as a way and put it in robotics in Fremont, that whole factory, as a way to help boost the stock? Because I don't know what your perspective, like if you were to listen to, say, Prof. Chi, he's always like, it's not a tech stock. He's been selling it as a tech stock. Well, if Tesla is leaning in heavily with SpaceX in doing that in robotics, it would raise the value of the stock. I mean, what are your thoughts on all that?
Don't forget, his mission is colonize Mars, right? Occupy Mars.
Yeah.
And I support that vision. I think you have to dream. If you only try to hit something out of you hit something out of the ballpark, you're only really ever going to hit the bleachers, right? He's trying to hit Mars. He'll probably end up on the moon, which isn't too bad. Don't forget that Tesla is always still going to be a tech company because he didn't invest. Nobody invests in him being a car manufacturer. They neither invest into the vision of got to get to Mars or all of the various industries that are necessary to get there. And so, space makes a lot of sense. Cars made a lot of sense because you need electric cars to, drive out in space. A sustainable future requires electric vehicles. But that factory space isn't what you would see Ford do with it, right? 120 years making just basically different iterations of that car and automating around a product.
Yeah.
He's not automating around a specific product or category. He's automating around what people need, I guess, to live on Mars, but a variety of other ways. So a variety of other reasons. So him discontinuing the X and the S makes sort of some sense too. They're not really volume drivers nowadays, right? People are realizing that there's fewer and fewer of them being sold. There's more and more competition at the premium end. So it's a business decision. Makes a lot of sense. Freeing up that capacity also makes sure that you can free it up for anything. And so happens to be, Optimus is going to be the next thing that they're going to make out of a factory in Fremont in Austin. So I think that's a great idea. And if only more of us thought that way. It's no different than a business pivoting, not fully, but pivoting slowly as things don't work. Imagine if you sell a product, doesn't sell so well, or it's reached at the end of its trend. Time to go on to something else. So that's how you keep that stock trading and people believing that it's going to be a tech stock forever and ever and ever, right? Google is, you look at other stocks that are what we call blue chip tech stocks now. Google was a search company. Well, no, I just took a Waymo to get here. Yet not yet quite profitable, but there is $1 billion industry involved in that. Cloud, TPU. So they haven't moved away from their mission. Google's mission is basically unifying the world through search, right? Or allowing the world to access all of the Earth's information. So I suppose when you drive around in a Waymo, they're mapping the entire world in real time over and over again. I suppose having data centers means that you can store the world's information or your version of your world's information. They haven't really left what their original mandate
But they also have the war chest, right? To do things like a lost leader as ways to help continuously rebuild their mode, if you will,
Hmm.
right? Because I mean, look at Amazon. They've spent what 20 plus billion on content.
Hmm.
That's not their business, but it is their business, right?
Hmm.
Because most people get their content with a Prime subscription, but it's helping them
Right.
indirectly or directly. But it is a loss leader for them, right? Because they're
Hmm.
not monetizing it the same way they will everything else, but it's helping them. I mean, what are your thoughts about that?
I think that Amazon kicked off the next generation of walled garden, right? So when
Okay.
they got the NFL, it made a lot of sense. Apple now has the F1, right? You didn't expect that 10, 15 years ago. It was going to go to a major TV network. It was going to go to an NBC or a Comcast, and you would just get cable. And so nowadays, they've actually done a great job. Number one, they've kept users realizing the value of Prime. They've actually made users forget and stop questioning. Well, if Prime goes up every year in price.
Yeah.
I don't think many people go, "Oh, it's up another $2."
And they'll charge you $2.99 a month to get rid of ads.
Yeah. Oh, I have to cancel that now. You don't think about that anymore. You go,
Yeah.
"Well, okay, fine. I have Prime for delivery. I've got okay, some of my content I watch the Grand Tour
Okay.
over and over again obsessively at night. Okay, I guess that's fine. I get it here. I can't download it anymore, in a legal way. And so I'll keep my subscription, I guess. Oh, it's up another $2, $3. Well, you know what? I get my groceries delivered to me almost instantaneously, or at least tomorrow. All right, I won't do that. Oh, I got to go to the grocery store with my. The most unfortunate thing they're closing down, I think, are the Amazon Freshes.
You like those?
I love them.
Yeah.
They're sort of a quieter experience. It's efficient. The biggest loss to me, frankly, besides the pricing and the automated checkout and the discounts all tied to my QR code or my Palm, I was telling some of my friends that the biggest loss is actually people who won't get access to fresh food. Because Amazon Fresh generally is opened up in places where there is a food desert. So
Okay.
that's the thing I think is going to be the most
What
unfortunate.
were some of the places? Educate me a little, because not the only one, but the one I would go to frequently was in Pasadena area-ish.
Right.
Sierra, it was right off Sierra Madre,
Yeah.
right, going towards the high school.
The
And
one I go to a lot, it's in like east of Fox Hills in Culver City.
oh, okay, so it's south of the 10.
Yeah, if you keep
Okay.
driving, yeah, I actually don't even know where the intersections are. I really should. It
That's
shows
all right.
How
We could figure it out.
how Angelino am I? But those places there is
Well, you live on the west side.
I do.
So for you to even get east of Gower is going to take you an hour at least.
Yes. I live my life generally west of the 405 most days. But I think most of the time it's sort of in the west side, and even still, like there's places that don't get access to good fresh food. Like
Yeah.
the closest grocery store that I looked at would be 4 intersections to
Okay.
the east, and it's sort of a discount store. And I think that's going to be unfortunate for the people there. But
Interesting.
back to Amazon, I think that you think that there's going to be a lot of disruption. I think they just make people not question why they still have their base Prime subscription. They run on that subscription.
Yeah.
140 million Americans have the subscription. Some of us have more than one. If you run a business, you got a business Prime subscription and a regular Prime subscription normally. And that lack of questioning, hey, how much am I paying for that? Content's just the value add.
It's like a new gym membership, man. You just stop thinking about it.
Yeah.
You just let the bill come.
It's that gym membership that it's going to take a long time before you realize, wait, how much was I paying? And I should really either A, go. And most people do make that valiant attempt once or twice before they actually cancel it.
Yeah.
So that's really where that Prime membership comes in.
I do. I look forward to when I'm at Whole Foods and I have to scan through my in-store code on the app, and then it scans and I'm waiting to see what are my savings. Because it's not always the case. But there are times where I get this great savings. I'm like, oh, yeah, there you go.
Yeah,
I
exactly.
get super hyped. I get my dopamine kick from it. You know what I mean?
Yes, it's an automated experience. It was built for people who, if they want to visit the store and walk through the store and touch your produce, you can. But if you want to just order it and have a touchless experience, you can as well. I think that's really where they innovate into different categories. I think the Prime content, renting movies. I rent a lot of movies on Prime Video on the weekends.
Do you?
Yeah.
As opposed to buying them?
$4.99. Well, it depends. $4.99, $7.99. If it's the same price to rent and buy, I'll buy it.
You buy it.
And they're really good at pricing that, right? So right after a piece of content's released, any movie is released, I think they price it the same price to rent and buy or close enough. So you end up
Okay.
buying
Yeah.
it. You never really watch it again. I haven't rewatched a lot of my
Not in my
movies.
house, man. We'll watch movies over and over.
And like it just replaced the DVD rack that I have, and now my DVDs are all in the basement. Just nostalgia. It's meant for eBay.
I'll buy them.
Yeah,
I'll buy your DVDs.
it's meant for eBay in 2040.
When the internet goes out and there's that buffering, like Peacock had a huge buffering issue with Super Bowl, I'm
Yeah,
just like, come on, what are you doing?
yeah. I had a huge issue on Sling. It wasn't really smooth for the first like 5 minutes. I think
Yeah.
they worked out the issue. That was good.
So going back to private equity, because the conversation you and I had previously when I was first getting to know you, you talked about how private equity is seeing a generational shift
Yes.
in who's actually deciding how are we going to invest this family's money. What do you see are what is your perspective on that? Because that's a big deal.
A lot of private equity isn't what we think of as traditional institutions, like the Black Rocks or the Fidelities. That's not where traditional private equity is sourced from.
Okay.
Imagine private equity is sourced from people who are, well, private individuals. These are people who made good money for themselves. It all originates at that concept of a family office. A family office is essentially, well, one family's wealth. And of course, there are multi-family office structures where you have multiple families getting together. They hire a professional operator, and it could be the same family. Imagine the Waltons. They have multiple family offices under the same last name because they need that level of governance. It could also be 4 or 5 familiar families, and they hire a professional operator because they know their money's better managed by somebody else.
Right.
Once you get past that, then the concept of wealth generation, wealth transfer becomes pretty evident. So, for example, the wealth transfer in the United States, I think it's about $7 or $8 trillion.
Okay.
But if you think about that, it looks like a lot of money, which it is. In Asia alone, there's 4 trillion there too. And then the Middle East, I don't have the numbers for that. And then there's, of course, European money, which is even larger because they've had they're a much older. These families are a lot older. They've passed wealth down 10 or more generations.
Okay.
We don't have that yet. And so that generational transfer is coming. So today, if you're likely in your 70s. If you were a boomer, you're probably a little older than that. You're giving up the reins. You've already given up the reins actively to any business that you run.
Okay.
It could be, you could make sauce, you could make property, you made your money in oil and gas. I've met families who made billions on a specific component supplying oil and gas pipelines, like just the cuff.
That widget.
The widget.
Damn.
Billions.
I wish I would have
Right.
been in that family.
But you can't make that money anymore, right? It's just not, you don't make money like that anymore, right? And so
It's
think
not as
about it.
or it's not as easy, but does it still happen?
It does. I mean, you can't start up a new company. First of all, there's regulatory. They did it because
That's
regulatory
true. There was a
looser,
lot less rules, a lot less
right?
guardrails.
And they've evolved with the regulatory.
Yeah.
Most likely, they influence the regulatory. And so, think of people in
That's
waste.
a fair point.
Yeah, think of people in waste management. The most consistent.
Oh, Wayne.
thing-
Is it
Right.
Wayne Huizinga?
Yeah, there's
Yeah.
just tons of money involved in, well, good or bad economy, there's going to be waste management. Property development. The last 30 years globally, we've seen a massive explosion of private commercial property development. Not so much nowadays, but you've seen that property development cycle. So people who are in their 70s made money in the old school, traditional, real economy ways. Let's put it that way.
Yeah, yeah.
Okay, well, what do? When you give away the reins of your family business, you tend to not give away control of your family. Generally, you have to pass to do that. But you're starting to see individuals give up decision making of their family investment decisions.
Okay.
So if you made money in traditional industries, you probably invest in things near and around traditional industries.
That's what you know.
Property. Yeah, property, probably the closest thing in tech you do is prop tech. You might invest in construction, you might invest in something else like that, but you're probably not doing space tech. It's a little too far for you to understand.
Yeah.
Crypto, geez, like, no, US dollar's fine, like those folks. But as you start seeing kids who are in their 40s, early 50s, they're taking on the reins of that family decision making. They also have an interesting thing. We rub up against a lot of businesses where they're selling, and you ask, well, you have really high quality business in advertising, in marketing communications, especially. It's a services business. There's very little to really take over in terms of meaningful skill set from a manufacturing kind of standpoint. It, they go, well, my kids never wanted
Yeah.
that. They don't want it. Oh, okay. They don't want to deal with it, and they're putting them up for sale. That money is much younger. They have an objective where they want to invest in different things. So we frequently see that tension in families where, okay, the older generation has made their money in traditional economies. The younger generation now has the ear of the asset manager, and they're going to invest in space tech, AI, data centers. And so you can imagine the tension that creates, right?
Yeah.
It's like I was explaining this to some of my relatives. It's like when your 8-year-old wants an iPad, and then you tell them, listen, I didn't even have a cell phone when I grew up. Well, I did, but some people might say I didn't have a cell phone growing up. Why are you giving them an iPad? This is way too much. There's going to be all these problems, these regulatory issues, compliance issues, attention span, focus, and so that generational wealth transfer is now disrupting a lot of traditional asset management uh, brands, where in the past
Mm-hmm.
you may have transferred a large portion of your wealth to a traditional asset manager. Today, the younger generation goes, well, I have all this information at my fingertips. You know what I'm going to do? I'm going to hire a professional manager in-house, in the family. Oh, okay. So suddenly it's not sexy anymore to be a portfolio manager or a relationship manager at a major institutional bank managing ultra high net worths. It's now cool to work as a portfolio manager / asset manager inside a family office, because you get to see really cool deals. You get to deploy capital at scale. You have the trust of like the owner of the business of the office, and they're deploying things very, very much differently than um, the older generation that's given them that money.
Yeah.
Let alone individuals who made their money as the first generation. So these are folks that are probably, again, in their 40s or 50s. They made money in newer industries like their CPG. They sold their CPG brand. They
Do you
sold
see
their
a lot of
wellness brand,
SaaS people?
SaaS brands,
Yeah.
startups, even now much younger, but I don't think they're at the family office level. AI billionaires, right? What are they investing in next, right? So that generational transfer of wealth has now hit us.
Mm-hmm.
You are starting to see individuals in their 40s make decisions on investment decisions, and that's what's causing, and that's essentially what's fueling all of the uh, AI, space tech ventures that we see today. They have a higher tolerance to hold onto an asset for much longer. They're younger, right? They don't need distributions or dividends for years. B, they have a higher tolerance for risk. They think that you can 100x this thing, not 10x it, because they have
Yeah.
time. If you hold it 8, 10 years, you might 100x it. So that's why you see a lot of people invest in the SpaceXs, et cetera, in the
Well, it's
second.
been glorified. Venture capital has been way more glorified over the past 20 years
Right.
than anything previous to it, because our media cycle is so different now.
Well, the media definitely helps in hyping just a limited number of assets to the point where you create the Mag 7, right? And I think that makes for better or for worse, people then all rush into that, right? And all of its associated businesses. And if you just mention one or two industries, people are going to go into it. SpaceX, space tech really wasn't anything until, except early stage. It really wasn't a meaningful place to put your money from a secondary standpoint until 2023.
That's fairly recent.
That's very, very recent. I mean, early stage investors were looking into space tech as early as 2017, right? SpaceX was already around,
Was
but
Blue, what was it, Blue
Blue
Origin?
Origin,
Yeah.
right? But that in that case was still very much a game limited to institutional
Right.
investors, those visionaries, right? What I'm talking about is this next generation of wealth. They probably would not have participated in it till at least after 2020, 2021. And then it went mainstream in 23, and everybody's talking about it. And today you now start seeing exits of the original 2017-18 batch of space tech companies that have survived,
Yeah.
have a value in society, and generate true value.
You mentioned a couple things. Some of it I want to ask you about, but kind of because there's so many questions. I have like 3 questions I want to ask you all at the same time, but I'll just go through it kind of simply. first off, as a private, I mean, you run a private equity company
Mm.
and you have to, build an LP base. How do you attract that new money? Or
Well,
it's old money with new decision makers, I should say. It's not new money. I shouldn't put it that way.
it's folks with money,
Okay.
and you know, money is surprisingly traditional, regardless of what it invests in. Um, put your money where your mouth is probably the first thing. The LP base that at least we interact with wants to see that you're going to be investing with them.
Okay.
So what's your GP reinvest? How much are you going to put in if we put in this? And we co-invest with our LPs. And that's a sign of conviction.
Yeah.
So many people are out there asking for LPs. They have track records and there's nothing wrong with it, but so many people are asking for their LPs just to invest in their fund for them to manage. As an LP, you feel like, well, okay, so that those fees suddenly feel like it's all me and my risks, and that carry feels like it's all my risk, and what are you putting into it? So put your money where your mouth is in terms of if you're going to sell something, if you think this is a really good idea, if you're convicted about this particular category,
Yeah.
these kinds of businesses, then go in together. I think that's really important to identify at the outset.
Right.
Two. There's two schools of thought to this, so I'm going to use the first school of thought, which is be humble about it. Some other schools of thought are go big or go home. When you raise, have a list of targeted businesses or similar ones that you want to raise against already. So you come to the door with bearing gifts and fruits and all that stuff, right? I think that's really important for a lot of folks who are raising for LPs, especially since you're going to be taking that GP role. 3, operational excellence. So don't invest or don't convince an LP to invest in anything with you and be that GP or that co-GP if you don't have operational excellence in that series of business. So what do I mean? For us personally, I own and operate a series of advertising agencies. The PR agency, paid media, principal media buyer. We have a web and tech development company that does a lot of AI nowadays. And a branding agency. Now, those 4 things, we choose to go in with our investors and say, hey, listen, have you ever seen that deck where, especially if I'm not speaking of AI or space tech, I'll speak about fashion, luxury, beauty, wellness for a minute. That's probably easier to understand. CPG, it's easier to understand. Whenever we meet a founder, when they raise something, it's always like use of capital. Anywhere between 25 and 50% is marketing. Okay. So I can go to the LP and say, hey, listen, I run a marketing firm.
Yeah.
I sit on identity solutions and data. So don't worry, that CPC and that CAC, what they say, it's probably half, meaning that you're going to still invest the same amount of money in them. Please don't be cheap and invest half. But it means that they can go further with that money. 2, we have a team of people. So we're not only funding the business, we are also funding talent and we're funding growth.
Yeah.
So fewer people will show up on the cap table or the ops table, the P&L, in the marketing side of things.
Yeah.
And so doesn't that make the EBITDA of the business look a lot better? And LPs generally go, oh, that's interesting. So you're going to come in, you're going to make sure that they're managed from a marketing standpoint, which is a large expense for a lot of, let's say, CPG brands, FLBS brands. Okay, great. I have confidence in you because the unique advantage that we have isn't that we can fight for money better than other people. In my world, there's plenty of capital to go around.
Okay.
It's who do I want to invest in? Because LPs have, for good or for worse, they're the people that can call you at any time. They're going to call on you and they're going to call you. Calling me is fine. Let's just pick up the phone. That's okay. Calling on me means they're pulling their funds. And so if they want to know, they want to have that trust and confidence in their partner. They don't just want me doing financial due diligence on the company every year and reporting out my quarterly statements. They want to know, how did we get involved in improving the outcome of the businesses that they've trusted their money with us.
And that's more of a private equity thing than it is a venture capital thing.
It is, but venture capital is moving into that space now too.
They are. They're very much so. They're trying to be operators.
They are.
More and more.
And I give credit to some of the CPG investors there today. You look on their websites, there's creatives, there's e-com ops people, there's social commerce folks, ex-influencer agent, ex-CAA, ex-WME people. And they're there why are they sitting inside a venture capital firm? It's because they understand that the check comes with, they want to be smart money.
Yeah. Well, so when you spoke a little bit about how some of this newer generation, the 40, 50-year-olds who are
Mm-hmm.
now taking over decision making, they're bringing some of their advisors in-house or even hiring somebody internally from the family. I mean, does that kind of also coincide with the fact that now you have all these financial influencers, right? Like a popular podcaster, she's also an influencer, is Cody Sanchez.
Mm-hmm.
And she talks about buying these archaic business that most people this generation doesn't want to acquire, whether it be laundromats or even roofing companies, right?
Yeah.
But I
Vending
mean,
machines I saw.
there's
Yeah.
so many of them, financial, I guess you'd say, they're not advisors, they're just influencers.
Mm-hmm.
And because information is so much more readily available, right? Like you could choose to do a lot of things with your time, your bandwidth, but a lot of people now are just going on, let's say ChatGPT, Gemini, and just asking them questions, and it's giving them feedback of like, oh, would I invest in something like Goff, like Guggenheim, because it has a dividend return, or should I invest in just go in Robinhood and invest in crypto? But regardless of whether or not it's misdirected information, they are able just to go access it, right? And
Mm-hmm.
kind of almost do what most people did when web came out with WebMD. They could self-diagnose, right?
What do you mean?
So
We still self-diagnose?
yeah, we still self-diagnose. It's true. It's now we're just more advanced self-diagnose, I guess.
At least now you can chat with your real doctor
But
through an app.
how does this affect your place in private equity?
It doesn't,
It doesn't.
because content's for it. Again, going back to Prime versus Apple TV, I have both because you need both, and also YouTube TV because you need all three to get all three sports.
That's right. They got soccer too.
Yeah, they got soccer, they got hockey. I think it's the same for, financial influencers are there and especially like Cody Sanchez or my rich BFF. They talk about different things. They're not there to give financial advice to folks who work in um, venture capital or private equity. They're there to tell consumers, make regular consumers realize, oh, there's something you can do,
Mm-hmm.
and you can do it with it. For example, car washes, right? They talk about, I've seen content about car washes. I've seen content about coin op laundry.
Yeah.
If you're the kind of person that likes the hustle and you like staying busy, and there is a meaningful, and you've done, and you know how to do the financial analysis on location A, B, C, and then put them all together, I mean, good on you. I think that makes a lot of sense for some people who are seeking that kind of level of activity, that level of that's going to be something they enjoy doing. It really is, to some extent, passive income for them. They've invested in it once. Generally speaking, there's a need. You need to coin op laundry. Good day, bad day, coin op laundry. Recession, coin op laundry. It's like waste management. You need to throw your trash away and pay your tax bill every time, every quarter. So I think that those businesses and that giving that advice to people is interesting. I'm not here to give financial advice, but I think that for most people, the most stable thing to participate in the American economy in general is still a low-cost index fund. And like, you can buy the S&P if you want, you can buy the NASDAQ if you want, you can buy any indice you want and buy a broad swath of the US economy.
Mm-hmm.
But no, it's not as exciting watching, the QQQ or the SPY go up and down every day. It doesn't do very much for you. So some people want to own 50 laundromats and participate in the economy, and good on them for doing that. But it doesn't impact us, because the opportunities we talk about are things like secondaries in Series A, B, and C businesses. Again, high quality businesses, $5 million plus in revenue, all the way up, billions and billions of dollars in revenue. How can you participate in those businesses? Right? Instead of owning and operating it, how can you participate in it? Traditionally, been a walled garden, accessible only to billionaires. Today, accessible to basically anybody. So that kind of participation is very different than participating in sort of the traditional economy or owning a business.
Yeah.
And a lot of influencers are also giving advice on how to. I think the best influencer advice, if you will, that's emerged is how to start a business. If you approach, there's nothing more beneficial than starting, going through the process of building, and operating a business, regardless of the size, because it changes your character. It makes you a far more resilient individual. It makes you a sociable character generally, because you have to talk to a lot of people for anything, fundraising, customers. I think that's great. And C, it teaches you the concept of fundraising eventually. So it's not, it's not, you don't have to pay 1 hour's, you don't have to put in 1 hour's worth of work to get X dollars per hour, which is what most of us are taught in the middle upper class, in general. It's now, wait a minute, I've put in those hours. I really didn't get paid really well for it. But now someone's recognizing my hard work.
Yeah.
And that really allows people to climb up the social ladder. And so if anything, what these influencers are doing is they're opening up the eyes and ears of regular average Americans watching their content and going, huh, yeah, I could own a business. Because there's some people that are really bad at starting that first step.
Yeah.
I'm really good at starting a business. I would think that today I have 100 staff member around the world, 100 staff around the world. They're running the business for us. They're all equity. Some of them are equity partners in our business because they're better at operating it than I am. I have a terrible bedside manner. And so asking me to talk to clients day in and day out, not that I don't respect my clients, but it might be a little bit brash. And so you have people that run that business. And so these financial influencers are actually saying, well, if you read their content, you could participate in something else. Maybe you are working an hourly wage job and you've got a little bit of money saved up and you think, well, there's got to be something better than this. Someone's got to help me make money while I sleep.
Well, then what about the future of influencers in private equity?
Ooh,
Because
okay.
we even get roofers, because we have a studio that we rent out and we do stuff for other people through our production company. We get roofing companies hitting us up now going, I need a podcast because I lost out on a few deals. These are enterprise roofing, mind
Okay.
you. It's not,
Yeah.
just your normal track home roofing, but it won't surprise me if it gets to that point. But they're like, we don't have a presence. Our client went with another company simply because they went to their TikTok or their YouTube page.
Yeah.
But I mean, in private equity, how are we going to see the evolution of that?
So there's a fine line between giving advice
Yep.
and
Don't worry, we have a disclaimer before this
great.
starts, just so you know, we're not financial advisors, wealth managers, lawyers, or CPAs.
Yeah.
This is merely just us sharing our experiences. I have this disclosure down, let me tell you.
Love. There's a fine line between giving financial advice to somebody and doing that for entertainment's sake, right? So I think the financial influencers will continue to open the eyes of people of what you can do and what you can't do. For example, I see a lot of influencers today online talking about taking part in basically startup secondaries. So what does that mean?
Yeah, I've seen
I got Series A businesses, Series B businesses. They're probably sponsored by a so-and-so platform that I won't name drop, and and they're talking about the accessibility to doing that.
Yeah.
Private equity manifests itself even as simple as years ago, Masterworks, right? You're talking about fractionalization of art. You can't
Yeah.
own the piece of art, own a little bit of it. Well, what is that? That's essentially the beginnings of tokenization, and that makes a lot of sense. People advising you could own that art. Well, if you're an art collector or if you're an aspiring art collector, great. Then you have an asset class for yourself. What it means for influencers in the future, I think, as long as they continue to open the eyes of people as to how they can participate into the world of private equity, then it's fine. Give you a good example. The best kind of the best kind of advice or the best kind of content to entertain people on might be how to sign up to, how to participate, how to analyze a safe agreement. And that sounds boring, but
Simple agreement for future equity, if anybody was wondering about that acronym. We got a lot of acronyms.
thank you.
Yeah.
Even so that folks can understand, okay, so what does that mean versus a safe note versus a convertible note
Yeah.
versus a straight up debt loan? What do those mean? I think that's great. Let the user make a decision on who they are going to invest in and what they're going to invest in. But I think that's a good idea. I think that as we start seeing the democratization of private equity to just regular folks, you're going to see a lot more influencer content about that. It's no different than when we first got access to cheap real estate loans in the U.S. during the pandemic. You started seeing a lot of influencers talking
Yeah,
about
even
building Airbnbs.
REITs. started exploding. There was crowdfunding REIT sites.
Yeah.
Remember, like Fundrise?
Yeah. Fundrise.
Yes.
There's going to be a lot of, I think moving forward, there's going to be a lot more of that. And I think that that's actually not a bad idea. Again, the democratization of information is always a plus. It's you also have to make sense of it. You can't just consume the content and go, I'm going to go do this. You have to make your own decisions on, do you have a $50,000 check to write that you could lose? It could go to nothing tomorrow.
That mindset alone, right?
Right.
Oh my God. So we used to run a meetup, a real estate meetup, and a lot of the people would come were newbies to real estate investing. And we would always open up with like a haves and wants so anybody could participate 30 seconds, get up in front of everybody, tell everybody want, because you'd always have somebody up there hawking a house deal or maybe some notes, whatever the case. But it was mostly based around the fact of we would always tell people like, hey, if you need to be comfortable with losing, especially your first few investments, you have to be comfortable losing it because otherwise the toxicity of stress will kill you. I can only imagine with your LPs, how do you deal with that? Do you end up becoming almost like a therapist at times with these people?
Well, I think it's like this. Traditional private equity and venture cap
Yeah.
are run, I mean, everybody is bound by the same set of rules and regulations, but they run in a way that's company to company, corporate to corporate. It's very much reporting. There's timelines. There's investor committees. There's audit committees. There's things that you have to do. And generally speaking, a lot of it's down to traditional what we call relationship management. Let's go meet at the game. Let's hang out on the end of year party, Christmas party, ugly sweater party, whatever it might be. But the world of family offices, which is a component of private equity, is different. The LPs are different. GPs are different. You know each other. Business is personal.
Yeah.
And so, generally speaking, though, you're unlikely to be investing in you're unlikely to be invested in, or you are unlikely to invest in somebody that you either don't know a little bit of, have some kind of compatible background, value their experience, and have gotten to know them. There's not a single family office LP GP relationship where the relationship between two individuals prior to sort of financial transactions don't take years to build.
Yeah.
Right. So, with that said, managing them is a little bit different. You have to understand the tonality of their family. You have to understand what they like to invest in and what they don't like to invest in. You have to know when to pull that lever and say, trust me, this is a good opportunity, and not use that trust me and ruin.
Oh, that makes you accountable.
Makes you
super
very
accountable. You hear that word.
Right.
Trust me. I hate when Sam Altman tells me that.
Yeah, trust me, right?
Pumps me out.
You have to be very careful not to do that, because in a relationship where you're not friends in that sense, but you're really familiar with each other, you tend to use colloquialisms a little, even more casual. You have to hold yourself to an even higher professional conduct, because if you walk around traditional family office structures, they look more casual. People are younger. They may come from the same institutions, but the reason why they're not at their institutions are because they want to have a little bit more of a, not a casual approach, but a more human approach to how money is managed. The people that they manage, the portcos, the portfolio companies, and also the people who invest in them, they want them to be more human in whatever point of view they're seeking. They want to be more aligned with the people that are allocating capital to them. And so you're right. I spend a lot of time having to answer, again, being called, not being called on, being called, sort of explaining this, explaining that, how that maps with the senior. We call it how it maps with senior and junior. So what does
That's
senior
interesting.
think? What does junior think? In a traditional private equity situation, you don't really have those conversations. Maybe the RM does, the relationship manager does, but we have to go, what does senior think? What does junior think?
Are you a mediator ever?
Is that going to happen? You have to take on the role. You have to be diplomatic.
Right? Yeah.
You have to be diplomatic. You have to be patient. Some days they got out of a bad meeting. You're the next call. Well, it's coming. Some days they have a great day.
That's valid.
Super relaxed.
Yeah.
And you go, great. Today seems like the day. where we can actually push through this agenda. There are going to be those emotions.
Yeah, yeah.
There are also, of course, conditions. Every family has a different expectation of why they're doing this. The investment mandates are far more, again, personal. They want to get into, or they understand that space, or they have a passion for um, a specific industry. And so we have to then make sure we find the right kinds of businesses. When I'm interviewing portfolio companies, it's not just about, hey, give me your pitch deck. How's your data room? Walk me through the financials. Walk me through the plan. We do our own due diligence. We still have to do that. But I'm also interviewing the founder to go, we were all at a Christmas party. How's this going to work? And
Well,
that's
because you're going to have to talk to that person
what if
so many
Well,
times.
what if we had
Yeah.
to use, and I work with families who are celebrities. What if we have to use, what if we had to, because it's a cheap source of sponsorship. What if we had to use celebrity A or B to brand ambassador this thing? Because, oh, they might like that because they mentioned this or they have that tonality. You don't have to account for that in I would call institutional money, but you do in the family sense. That's why you get a lot of folks, if you peer into any single or multifamily organization, um, the people are very diverse because most founders of family offices understand that they want different people, not all of like the same kinds of people. Otherwise, you have your blinders on when it comes to investment. But it's actually the investment, the portfolio companies and the LPs are actually going to be. They somehow imagine the virtual Christmas party. I always say they somehow all get along. Huh. And that is the role of the GP. You're a little bit of a therapist. You're a little bit of a mediator. You're always a mediator, and you are also entrusted when time comes, lay down the hammer.
Yeah.
This is the direction we're going. Because you have to don't forget that you are still hired to navigate the investment decisions to a certain place.
Yeah.
You are
That's
ultimately
valid.
responsible. An LP is great. I would love one day to be that billionaire LP that uh, is just capital allocating to people I like,
Yeah.
because ultimately we have the ultimate responsibility, the unlimited responsibility to how these portfolio companies are performing and to how also the LPs feel about their situation with us.
So you're in an interesting space, in my opinion, because when I first was introduced to you, I was wondering, I'm like, how are you guys finding value in agencies and marketing companies, PR companies? Because as having ran and owned one with my other co-founder, and we did really well, the value in the IP, I should say, the IP in it's hard because it's mostly relationship based.
Very.
And so I asked you, where do you see value? So where do you see value in these companies as a private equity person?
So there's the difference between operating and owning an advertising agency. So in the traditional space where big fish bought a medium-sized fish, bought a small fish, and they were all ad agencies, there's a lot of egos, and we're seeing that right now in the market.
Ooh, yeah.
Mergers and acquisitions. This day, which brand are you from now? What email do I use? The big fish is now the big. Everybody's using this email, or oh, that brand doesn't exist anymore, or this CEO's out. That model is likely going to be heavily disrupted, not only because the world of private equity has come in, and I'll explain that more later, but also because AI is heavily disrupting the process of advertising.
Yeah.
There's a
Oh,
lot
yeah.
of people that sell process in advertising. Project managers of all kinds, technical project managers, creative project managers, all kind of project managers. Those are being disrupted. Publicists, you may have needed 10 of them in the past. Now there's 3 AI publicists for every 3 publicists that you have at the firm. We ourselves as a company openly market to our clients and prospective clients. I've said to the advertising business, you can openly tell clients, yeah, we have 100 odd employees, like people, and we use something called not artificial intelligence, but augmented intelligence, and there's 200 more of them. What
Yeah.
do you mean? Well, we don't have a QA analyst that QAs our code anymore for the AI and dev team. That's all run by Claude or whatever Oscar is using today. And so, great.
What you using, Oscar?
Yeah, what do you use? He has an unlimited AI test budget, which is kind of scary.
Damn, Oscar, I
Everyone
want to
just
hook up
go.
with you.
Everyone goes to him. It's like, I want to test Claude. And my last week, my legal team went to him and said, "Hey, we got to test this new legal assistant
Yeah.
from Claude," and it works. And now the promise I've made and I have to write an email to the compliance team. Like, don't worry, nobody's job is at risk for contract reviews because none of us should really be contract reviewing without AI anymore.
Well, if they see a shipment of a bunch of Mac Studios, right? So you're building your own little server,
They're like,
and
oh,
one of
crap.
the offices are, wait, what?
Yeah. Oh, that's me. But I think advertising businesses at the end of the day serve two purposes to our investment mandate. The first, financially speaking, they are still a cash flowing business, right? There's a cycle between when you pay vendors and when you get paid. Now, those cycles are harder to manage and harder to manage. You run an ad agency, clients.
I did.
They they like to use us as the bank.
Yeah,
Right.
we live afloat, maybe.
Live through that. But in a combination of various, if you have an integrated agency, that float's manageable.
Yep.
If it's a pure creative agency, problematic because a lot of stuff's prepaid. If it's a pure pay media agency, fees are low. It's run like a grocery. I call it a supermarket now. It's a supermarket, and that's also bad. But there is a float. Web and tech agencies typically lower cash flow, higher profit margins because they can constantly reinvent enterprise tools and clients kind of need them. PR agencies, again, typically there is a float, but again, the revenue numbers are generally pretty small. Profit margins are there. If you combine them, though, then you've got a pretty happy balance. So financially, they do make sense. It's also something that is functionally needed in private equity. So we are seeing a dramatic shift in the way advertising is done. So for everybody out there, the boring world of Mad Men is a $1.6 trillion industry globally. It's $1 trillion enterprise nobody talks about, everybody hates, right? And everybody loves, well, some Super Bowl commercials.
What do you think of the Coinbase one, where they basically had you doing karaoke to Backstreet Boys?
I think they may have taken the crypto.com ad a little too seriously. So let's make something crazy too. I think that's the thing. Ad agencies are needed to entertain people. Good creativity. For better or for worse, I like what Budweiser did. They took it they took it from one extreme to the other.
Well, Post Malone drinks a lot of Budweiser. Or was it Bud Light? Bud
Light, right? And you have and then you've got Levi's. The ads are those ads are back.
I like booty, so yeah, it made sense.
Wasn't too bad for people who like that.
It's like if you like butt, yeah.
And then Dunkin's usual star-studded.
Oh my gosh,
how much was that commercial?
My goodness.
Was it good? Debatable, but was it full of celebrities? The answer is, how much did it cost? Did it work? Yes, because you're now talking about it, and we are talking about it. I think that the Coinbase ad was, again, that needs to be. If you're an industry that's brand new, you want to create something cool. You still need a good creative agency. I credit, for example, let's look at two new industries: Coinbase versus Claude. Those ads, really good.
What do you think about the OpenAI ad? It ran earlier, and maybe it was just part of the normal cycle.
I like the Claude ads better because the Claude ads, well, definitely they were taking a stab at OpenAI.
Well, yeah,
but the way that it made you think, and it's kind of intelligent in the way they cut in that humor where you're just talking clearly. If you weren't paying attention to your TV, you just notice that slight delay between the prompter and the humanized version of the AI. That was done by Mother, right? It's done by a storied creative agency. They know how to tell a story.
Oh, I didn't know they were the agency that did it.
Yeah.
Okay.
So you need to know how to story tell, but you also need to know how to buy the media. So. Yeah. You also have to know how to do the influence. You also have to know how to do the social part of it. But anyway, this is what's happened in the last about 6 or 7 years. Globally as a trend, not specific to any market. So we look at markets around the world. We have offices in Singapore, we have offices in Bogota, we have offices in Santa Monica. So we are all over the world. In the past, when I first joined advertising 15 years ago, probably about 70%, 80% of every brief was an RFP. Now, yes, some RFPs there's a preferred agency and someone they want to work
I
with,
remember the RFP madness.
but you got an RFP.
Yeah.
And you did your job, and you fought, and you knife fight, a la Captain Kirk and Spock. You would knife fight at the Ponfar, and one of you would win. And big celebrations. Everyone went back to work, and you did that again next week. And you did that 50 weeks in a row, and you wondered why you aged. So RFPs were great. Almost 80%, if not at least 3/4 of the industry got an RFP, and you would answer it. And barring just looking at the world of meritocracy alone, you would win on your merit. You go in there, it was a pricing game, it was a creativity game, it was a strategy game, and you impressed the CMO or the VP of marketing or the VP of media, whoever you needed to do. Great. Fast forward 15 years. The only people left pitching out their work to agencies are the big boys, the Fortune 1000, the Fortune 5000 companies, because by rule and by compliance, they have to every X years, and also government. So think tourism boards, think government economic promotion, that kind of stuff, but also think Unilever and P&G and all those guys. They will always pitch their work, but the thing is, they're so big.
Yeah.
There's only so many people that can join.
Look at TikTok. We had that conversation. Look how many agencies they've burned through.
Yeah, there's one every few months. So the thing about advertising is it's also being walled off. Why is that, though, you ask? Because the brands that are being generated today, that are being birthed, think as far back as like an Oatly or a Poppy or anything else, like a Farmer's, whatever you want to think about. These are private equity owned brands. Huh. And what do? They're they're asking that their brands find a cost-efficient solution. Generation one of private equity invested consumer brands that needed advertising, they would go out there and hire freelancers. They would hire it in-house. Then they realized, hey, wait, we're an AI company. We're an AI cybersecurity company. We don't do marketing really well. You know what? We need an agency.
Yeah.
Okay. And then they go and they source for an agency, and they get the costs and the quotations back, and they go to the board. And the board, which consists of their investors, go, wait a minute. We have one already. We've invested in one. It's in our investor pool. Okay. And so if you're an advertising business sitting on the outside, not being private equity owned, have no affiliation with private equity, you're missing out on almost 70% of a $1 trillion industry today, over $1.7 trillion industry today, in terms of deal flow to yourself.
Yeah.
And that's what we're seeing now in that market of advertising. There's consolidation of mid-size independent agencies. Our agency business, Helios Worldwide, sits on the board and is a shareholder of Worldwide Partners, which is one of the oldest independent advertising agency networks out there.
Yeah.
And the conversation we always have is, being mid-market used to be great. Not too big to be too good for clients and pick up great work and do great work. Not too small to not qualify for the pitch. Nowadays, that's actually a detriment. Too landlocked, likely in one particular state or region of the States or in one country, and they're really good at it, but they can't service a global client who has a brief that no longer says U.S. It might say North America, and you're like, well, how do I Canada? As a lot of them are thinking about that.
Well,
How do I
born in Toronto, right?
Was.
Yeah.
More about that later. And today you're starting to see advertising agencies go, well, okay, I know what I have to do. Either use, if they are well managed, use the equity that they've built and the profits that they've built to launch a fund or accelerator, or join up with a private equity entity. Because think about it. If one particular ad agency in one way, shape, or form joins up with a private equity entity, you could access to hundreds, if not thousands, of portfolio companies. That's a great business development tool.
Yeah, it is.
And secondly, it is the trend that's going to occur, where these briefs, these RFPs that are going to be issued out there that have no strings attached in general, are going to be fewer and fewer and far in between. And so we predict that that market will continue to exist. Advertising agencies have started dying the day they were invented 120 years ago. Great. That industry will not die. It's just, how does it look like? Who owns and runs them?
Yeah.
And what is the purpose they serve? The purpose they serve is the same: to entertain people, to deliver that message effectively to a group of people in a cost-efficient way, and to influence people in making purchasing decisions. That's not going to change. It's who is going to be part of it. If 40 years ago it was big, medium, small fish, same industry, all owned each other, the future will be you're just all different colored fish. It's like a koi pond, all kinds of fish. And so you're going to start seeing private equity money, LPs. They have their brands that they invest in. They also have a marketing communications arm. They may also have a influence arm as well. They're going to start investing in publications
I mean,
and all that too.
Binance bought CoinMarketCap, and I mean, so many brands own so many media outlets now. I mean, even the Golden Globes podcast award category, the majority was owned by the same company that helps produce it.
Yep, exactly it.
So, yeah.
And so in the old days, it was the event agencies would run, the event agencies own the award shows, right? They still do. And nowadays, you're starting to see the event agencies, the award agencies, the award shows, and the publications behind them all being part of the same sort of sphere of influence. And that's no different than getting a business off the ground. Again, if I'm sitting here as private equity thinking, wait a minute, 25 to 50% of this company is to do what? Marketing.
Yeah.
You can only do one of two things. Take out the ruler, or take out the marker, the proverbial marker, and cross out that line. Say no, which is not the smart thing to do. Or you can go, okay, how can we be really efficient about it from day one?
Yeah.
Well, we have a profit-generating marketing communications infrastructure. Okay, not saying you can't use, not saying you have to use all of them. And we don't do that in our investment mandates. We don't tell our portfolio brands to go, you have to use all of us or else, we don't do that. But you have to pick something. They still have to go through the interview process. Everyone has to jive. There has to be a specialty that we have. We expect that they're going to use external vendors, but a lot of that capital is kept in-house.
Yeah.
And it's no different than if you think about, let's go back to the example of the AI circular economy. I mean, OpenAI's first investment was from Microsoft. It was $11 billion, but it was all Azure credits. Everyone wins.
Yeah, right. And then they get access to the data. Well, so what you talk about, that ecosystem creates all kinds of opportunities. Can you share that story about Bruno Mars's rum, of how that kind of came to pass, like the opportunity that you had with it? Because that was pretty creative in a space to create value or to find the value that's there, right? And it was all built on relationships. I mean, can you tell the story?
I do remember the story of how we met Bruno. So we were actually working on a tourism promotion project for Brand USA, and that was the Corporation for Tourism Promotion, founded by President Obama, and it was to promote to everybody else come to the U.S. Right? And we had found a celebrity. She is widely known as the Mimi of the East. So her name is Jane Jia. And she was to be the brand ambassador for the country, for the U.S., for China. And she came to the U.S. multiple cities. And as celebrities go, one of her requests was, I want to collaborate with Bruno Mars. I'm like, that's okay. Not questioning where and why and how, just got to do my job. And so I knew a few people, and we eventually actually got to Bruno and his team. And they recorded the thing, and they did a really good job. And I thought that was over. Later on, they said, well, hey, listen, we're launching a new product. It's called SelvaRey Rum. Can you help us with a couple of things? I'm like, okay. We need to manage Bruno's social better. Can you guys help us with that? Well, yeah, we're kind of an ad agency. We kind of have a social team. Meet this social team high, and everybody met, and it felt good. And so we managed social. Lovely. Not too hard. And then they said, well, we're coming up with this new product. Oh, okay. It's rum. All right. It's going to be backed by Bruno. Makes sense. Sounds like it makes sense. And can you help us with it? I said, well, I really don't know a lot of at that point, we didn't know a lot of distributors. But what we did say was, well, what we can do is we can help find you distribution in Asia, because we somehow know, long story short, we somehow know a lot of distributors in Asia. We can help you with that. Combine that with sort of that social influence that we're going to start ramping up the conversation about that. And we also so happen to have found his next celebrity partner in Asia. So that helps, of course, to sell the product really well. And through that entire process, we took that risk of, well, what if the product doesn't sell? Because we had to bring in the distributors. Weren't sure if the product was going to move, and that's the risk. It could go to zero. It could be zero. It could be 100. And we actually said to them, well, this is kind of new. We can't really charge you by the hour here, which is what traditional advertising would do. Instead, what we're going to do is we're going to charge you by sales. If this thing moves into distribution channels, you're going to give us a GMV, a gross merchandise value, a percentage of your total sales. Yeah, that's a great idea. If you get us in, we'll do that. And so the relationship immediately became it became symbiotic, right? Our job was to be trusted to find a celebrity in Asia, was to take the risk of the product's importation, and C, only share in its success. So everybody had that inherent trust. Instead of, I pay you by the hour, you generate a plan. There's a lot of content that needs to be given. I have to review every single word because I don't know if you're going to say it right. And usually things are off by a few hours because you got to send a brief back and forth, and the copywriter's got to shuttle a deck back and forth, and an art director has to edit it, and a paid media specialist has to wake up in the middle of the night and buy it. Nope, it was all well planned ahead of time because everybody was on the same team.
And the end result?
It sold out.
That's awesome.
I think everyone was happy.
Regardless where the brand is today, that was the story of that bookend, right?
Yeah, we took that experience actually in 2018. We took that experience, and we are what we are today by when we invest in brands. Hey, listen, wait, we've discovered a magic power. We've drastically shifted away from being a pure play advertising agency to being one that owns marketing communications.
Yeah.
Lovely. That changes the mindset of everybody immediately, because brands who come to you don't treat you as this, oh God, every time you pick up the phone. It's like that feeling you get when you pick up a phone with a lawyer. It's like, oh God, I gotta end this call quickly. You don't have that problem. Or, hey, are they working for me? Or are they just schlepping a media platform where they get like lots and lots of like different kinds of commissions from it? There isn't that discussion anymore. It's just, we are now on your side. This plan is good. Yeah, we trust you, because if not, you're going to fix it. There's no, let's check in a week and look at the dashboard and fix. Nope, it's just, we fixed it on a Wednesday night because it didn't work.
Because private equity has a bit of a black eye in a lot of ways, right? Like, I mean, even the book The Fund that came out about Bridgewater Capital and Ray Dalio. Like, you're in private equity. What are your thoughts on the negativity that it does receive?
Well, there's no denial that in any mature-based business, I don't like people telling me what to do. It really is. It is what it is. But there has been a bad name in institutional private equity because they only look at the spreadsheet. So I'll give you an example. We go through due diligence. Everybody in the industry shares a similar 3-tab system. It's financial due diligence. There's enough questions to make you regret starting your business. And then you go through legal due diligence, which again makes it for a founder, it's a lot of work to answer.
Yeah.
And then of course there's operational due diligence, like where things are and corporate structures and cap tables and stuff like that. We add one and we call it marketing due diligence. And in that sheet, there's a whole bunch of questions. But through that, we kind of understand that, at least in our field of investment, and I can't speak for industries that don't have any marketing investment at all. Like, for example, when you think of AI or space tech companies, again, I'm going to say that their marketing spend is significantly less. So I can't speak to that. But we go in and we look at how can we make that spend more efficient by spending the same amount of money and not harm anybody that's involved. The traditional private equity curse has always been, oh God, I need the capital, but oh no, they're going to fire me and my leadership team.
Come in and pillage, level the earth here.
They're going to flip me in 3 years, whether I like it or not. They're going to tell me the products I'm going to make. So I tell founders this, right? There's a need for that kind of private equity in the world, because if you need to accelerate your business to the next level and you got an IPO, growth capital at the institutional level is what you need. And if you align with that, that's great. Most people, I would say 3/4 of the businesses we meet, want to find smart money. They want folks that are one of two things. One, they play what we call a permanent equity partner role. So we lay it out to businesses that we meet. We are a permanent equity partner. No, we're not going to stay on the couch forever, but we're not also going to exit at the next series if it doesn't make sense for us, right? So that gives them this reassurance that we're going to be with them for quite some time. And B, we want to roll up our sleeves and work. So how can we help?
Sounds like you're juggling, because from your standpoint too, you also have those 2 to 3 year turnaround options, but you have these ones where you are vested in for the long game.
Yeah, it's an investment strategy, right?
Yeah.
It's like if you purchase equities of if you buy stocks in the stock market, you probably have some high growth stocks, right?
Yeah.
One of the tech company names are probably in your life. And you probably have something paying dividends, like a pharmaceutical or an oil and gas company, so that you get a little bit of payout every quarter.
Yeah, like golf.
You want to exactly.
They do good dividends.
You want to just invest differently, and the same with holding different companies.
Yeah.
Like, for example, someone asked me, "Would you ever sell your marketing communications companies?" No, probably never, because that's part of the mantra of who we are and why we invest and how we are different than other sources of capital.
Yeah, because it's an asset to you.
Correct.
Yeah, in so many ways that you talk about.
We talked about this with we have a business we invested in that's a snack brand, and we probably will hold on for them for a long time because we have offices and all the boys and girls in the office love the snacks. But
That's funny.
but we also have we have a brand by the name of Aretzi. It's Swedish. It's all gold oral care rituals. All kinds of oral care is in it. It's all gold. And
Yeah, Sierra was telling us, one of your PR people was telling us about.
Exactly.
That was cracking me up.
It's probably one of those brands where we will exit at the right time. We will roll up our sleeves with the management team. They rely on us to do their PR. They rely on us to do their distributions in several markets in Asia. They also rely on us to look over some of their .com and their websites, just optimize, because they've got a big team at work. We don't want to cut the .com team. We just want to make up for the things that they could use some help on. And so those kinds of businesses, when the time is right, say a Caring came along to buy them, hashtag Caring buy us, I wouldn't say no to the exit opportunity. But today, they seem to be a really good business that is getting a lot of love around the world.
Aren't they going through a succession plan of their own?
They are.
Yeah.
So I think that with every growth company, there always will be changes in either leadership or direction. And it's pretty common.
Yeah.
I always like to tell people at our business, the reason why I'm either passionate or emotional, however you want to see it, of our business is because, yes, at the end of the day, if all things go to hell, I'm going to be that guy that turns off the lights and shuts the door for the last time. I'm always going to be here. So I have to take on all the responsibility.
Oh, I know that feeling.
A lot of growth stage
I
businesses.
know that feeling.
A lot of the growth stage businesses, you have professional operators. And so there will inherently have succession planning. The founders will always still be there. There's nothing wrong with the founders. They will always take part. But you don't have to be the face or the guy. I remind everybody look at Google's acceleration. I used to work at Google. The credit and success was given when Sergey and Larry took a backseat. One wanted to get involved in product. The other one wanted to get involved deeply into search. Neither of them were as good of a CEO as Eric Schmidt.
I know, he came in.
Twice. Yep.
Yeah, twice.
and put in a structure he knew because he's a professional operator. What does it mean, Sergey and Larry the company's going to change? No, for the better, because there is a understanding between all three of them. Yeah, Eric's not going to get deeply involved in the search algorithm. He's not. And and he's also not going to get involved in new products that Google's going to be interested in. You need all three of them to run the business. And so that's another thing that sometimes private equity also has like this bad rap of for the sake of replacing a founder or a leadership member just to save money and or install someone more professional.
Yeah.
Our point of view is it takes time. This is not something you can do in a month, but perhaps over 2-3 quarters, you can find the right place for each of those people on the founding team. Listen, their passion was to found X and to do A, B, and C. Maybe
Yeah.
they just don't want to deal with warehouse operations, but they took it on because nobody did it. Maybe it's a really good time in growth stage companies, $5 to $25 million in revenue, to go, wait, yeah, I can actually take a victory lap and go, I want to be this in the business and rekindle my passion in that business. I still hate in the office where I have to be in between, the cleaning crew coming in. I'm the guy that puts all the cups away. I hate it. Absolutely hate putting the cups away, team. But you end up having to do it because that's what you do. If
Yeah.
somebody came in and did that, I'd be relieved. But I don't feel like you're taking away that task from me and I'm being relieved of my command. In fact, I think that sense of relief sometimes involves coaching because again, back to the translation of investor LP and portfolio business. Oh, well, they're not doing a very good job, this and that. The red markers start coming out. Mm-hmm. Okay. But what happens to the soul of the business if you take away person A or person B? Well, doesn't really matter. It's all, the spreadsheet line item. Sometimes it's a little bit cold. And they go, this is how I think we should do things. And so playing that role of mediator is ever so more important in being patient capital.
Yeah. Mediator and curator almost.
Mm-hmm. But you still have, don't get me wrong, regardless if you're a family office or if you're institutional private equity, you still have timelines. You run in quarters, you run in years, and then you have an exit timeline. It's just that the way you do it may be slightly just more human and friendly because business is personal versus others. I can't speak for the Bridgewater system of evaluating employees. I think is complicated. Something I wouldn't use at my firm, um, but it doesn't mean that it doesn't work at the scale of tens of thousands of people to keep their performers. We also have a system known as the bottom five, and that's not pleasant for anybody to know that it's the bottom five, but it's done in a way that people know. And there's long conversations about it. And those that want to improve typically get out of the bottom five. Those that don't stay in the bottom five. And
Netflix, Reed Hastings, his second book, No Rules Rules, talks a lot about those types of models.
He talks about it being a sports team, right? So
Yeah.
he talks about them being a sports family, a sports culture. I think that's the best way to look at things. People will get traded. Okay. People will leave for a higher pay. People will get injured and they'll come back. Some people are benchers because they are. Some people are really good defensemen. I think that's the exact idea of looking at the portfolio companies you hire and the team that you do to go manage those portfolio companies, picking that right. It's all really down to being a people business. And, we don't have to be a multi-trillion-dollar hedge fund or a venture capital. I don't have a goal or a dream to be that. So I think that today it's a really good place to be where you can invest in founders still and see that vision come to life.
That's awesome, Humphrey. We got to wrap up, but thank you so much, man. I appreciate you taking the time, sharing the time.